Hey everyone, it's Paul with another incredible idea for what is clearly becoming a new bull market for our stocks. For our stocks, I believe that these are going to be the leaders. And hey, go look at stocks like Upstart, go look at Lemonade, go look at Palantir, go look at Exact Sciences. Yeah, it took a while, but hey, we are here. We are here. And today I want to add on to the amazing list of stocks that I have been telling you about on this YouTube channel. And hopefully you folks have been enjoying it and coming back for it. All right. So today, the number one hated real estate stock. Sorry, but the marker began to run out and I have to reorder. All right. As usual, before I get going, I want to read my disclaimer, which is that this video and anything that you ever get from me on Twitter, through my Substack, Instagram, Facebook, any place, this YouTube channel, not investment advice. We have not considered your personal financial profile, your risk, your assets, your income, all of these things which you should consider before you take any action on anything that we provide you. Past performance does not equal future results. Errors, mistakes, oversights, yep, human beings, we're human beings, and our team at ATG also human. That can happen. Capital loss is a likely and potential outcome. That is true for any operation in the investment markets. When you go to trade, speculate, or invest, it's always the possibility that you might lose. I, the owners, contractors, employees, associates of ATG Digital, which is my company, ATG Digital Media, own, trade, transact in the investments that are mentioned in this video and truthfully all of our content. All right, so let's go a little bit and break down what's going on in the real estate market. All right, so we've had this incredible move, like in interest rates. In 2021, interest rates were about 2% for the 30-year mortgage, which is the sort of benchmark. And we're now at about 6.5%. Interest rates, if you're looking at short-term interest rates, which is what the Federal Reserve, which is the arm of the government that sets interest rates, that has gone from 0 to about 5.25%. And somewhere in the next 3 to 6 months, yeah, we're going to see it peak out, and then we are going to see interest rates go down. And I'm not going to go into all of that. I really recommend that you follow me on my Substack, where I write about interest rates and macro things about once a week. We can see if you're tracking real-time inflation indicators like trueflation.com, that inflation is already really about to go under 3%. So the Fed is using lag data, and then of course it's lagged in its decision making. So they're at least 6 to 9 months behind. They might even be a year behind. So they're going to have to cut rates at some point in time. In probably come October, maybe November at the earliest. Either way, interest rates are set to go down somewhere in the next 12 months. I'm just giving myself some room here for 12 months. And the other thing that's been going on in the real estate markets, and if you're someone that's been waiting to buy or waiting to sell, you know this, which is that people who have 2% mortgages that they got in 2021, they might want a bigger house. They might want to move to another part of the country, but they don't want to let go of that 2% mortgage. So it's leading to a locked-in demand and supply. In other words, the folks that are willing to even pay current prices, well, they're like, there's not enough inventory because all the folks that want to sell, well, they're locked in by these tremendously low mortgages. The other things that are going on is that there is real estate 2.0 underway. And this has been sort of burbling in the background for a while. And the biggest sign of this is like the fact that commissions now are kind of being bid down or even negotiable. I mean, commissions have for the longest time been 6%. They're now almost by standard 5%. And if you're willing to go with one of these real estate 2.0 companies, Redfin, which by the way is not the number one hated real estate stock, they will give you a, let you transact for 1%. So there is very clearly this big shift that is going on in the real estate markets, which truthfully have seen almost no change for, I don't know, 50 years, 70 years, certainly as long as I've known it. In other words, when you want to buy or sell a house, you go to a realtor, and there is no choice. There is, you have to go with the MLS listing, for which then, you agree to those terms, and you're paying 6%. 6%, though, on, like, imagine like hundreds of thousands of dollars. I mean, it's a lot of money. So the real estate 2.0 revolution that is underway is to get real estate to trade or to transact a bit like the stock market. You go to your Robinhood account, there is a bid price, there is an ask price. So if you want to buy a stock, you have to pay the asking price. If you want to sell a stock, you can sell it to the person that's bidding. And this way of transacting real estate, many people are like, Paul, real estate is a completely different animal. No way, it's never going to happen. But you know what? Go on the internet today and put your house address in, and in all likelihood, you will see lots of ads offering to buy your house. I mean, this market is already unfolding. This is not something that is going to happen. I mean, it's a fairly small market share, but I believe that as interest rates go down somewhere in the next 12 months, a lot of people are going to be like, yeah, pay 5%, or just go and participate in this essentially like an online auction style market, where companies, have bid prices and ask prices for various houses, and where you get the chance to complete, the transaction online. Now, many markets don't facilitate this, but there are markets where you can do, I'm going to say 50, 60% of everything that you need to do in real estate online. And that is the other element of real estate 2.0, which is to take away this extraordinary amount of paper that you have to provide. And, for the incredible time delays, it can take 30 to 45 days to close on a house. To just, cut all of those things out, shrink the timeframes, which shrinks the uncertainty, and it also drives down costs because that uncertainty comes at a certain price. And what I believe is going to unfold is you're going to see the development of various real estate sort of investment banks that own inventory that they buy and sell. So you may not know, but Goldman Sachs, Morgan Stanley, JP Morgan, those folks, they're dealers in the stock market. They have, inventory of Apple stock. They have inventory of Microsoft stock that they will sell from you. And then they make it their business to daily to go and buy and sell and do and to look at demand and supply and make bids for various pieces of inventory. Small cap stocks are cheap. Maybe they might go and suck all that in because you want to dump everything. Maybe everyone still wants to buy certain big stocks, and then they make these inventory decisions that they can. Now there is a difference, which is that obviously the real estate markets are physical. Still, I can tell you that many people would not know this, but a long time ago, many markets, including the stock market, essentially didn't work actually very similarly to the real estate market. You might have to go to a broker's office and bring your stock certificate and a broker deal where you would pay 15, 20% commissions. So the idea that the real estate market cannot do this, which is an objection that many people have, is disproved. Not going to be disproved, is disproved. It's just that lots and lots of people are buying and selling real estate online. Now, my best guess is that the old-fashioned way will also continue for some period of time, but still the growth, and that's what the stock market cares about. The growth is going to be in these real estate 2.0 companies that are doing some version of all of those things that I mentioned. All right, so here are some other real estate 2.0 companies. These are not like, this is not like a comprehensive list. These are just some of the companies that are involved in this. Redfin, I mentioned, Redfin is $11 stock, $1.2 billion market capitalization. Remember, market capitalization is the way that you can determine if a company is big or small within the confines of the stock market. Apple, for example, is a $2.7 trillion stock. $1 trillion stocks. It's a very, very, very large company. You cannot judge the size of a company by the stock price. All right. So that's why I have market capitalization here. OfferPad, which is a 54-cent stock and a $227 million company. So very, very, very small. Compass, which is a $4 stock representing a $1.96 billion company. And then Zillow, which I consider to be sort of like the leader, blue chip, benchmark, if you will, of these real estate 2.0 companies, is a $45 stock, $10.8 billion company. There's two classes of stock. One gives you voting power, one does not. That's why you have Z and ZG, and you'll come across that. But nonetheless, those are some of the real estate 2.0 companies. I'm not going to go into a long analysis of that in the interest of keeping this short. And hey, maybe I'll do another video on real estate 2.0 stocks. All right, before I tell you the #1 hated real estate stock, little plug for my company, atgdigital.media. That is the website. We offer subscriptions. We have 4 tiers. We have sort of an introductory tier that begins at $9.99. It gives you sort of like a broad overview and of sort of bigger stocks, middle-sized stocks, small cap stocks, some micro cap stocks, and then a smattering of crypto. And then we have other subscriptions for sort of stock picking in small and mid cap stocks. That's our gold tier. Then we've got our platinum tier, which is sort of like our shorter term trading. It's not short-term trading, shorter term. In other words, period of like months. And then finally, we have the diamond tier, which is our micro cap stocks. You want to check me out and see like, hey, what does this do? And what does this company do? And how do we do it? Well, we write every day on a Substack where you can follow me for free. We don't charge anything for the Substack, paulmanpilly.substack.com. So check us out over there. All right, the #1 hated real estate 2.0 stock is Opendoor, ticker symbol OPEN, Opendoor. $2.67 stock, $1.72 billion in market capitalization. And it's all for the reasoning I laid out earlier, which is that Opendoor really is the kind of like the leader now of this transaction-based transition that is unfolding to a more capital markets orientation for real estate, where you can buy and sell real estate completely online, and you can try and do all of that online. But the most important thing is that it also like eliminates the big cost, which is this commission cost, and that I believe the savings from that are going to be so significant that it can really start to take significant market share from sort of like the existing very distributed, very widely disparate real estate world that exists out there. So some numbers about Open. I told you the stock price, which is 267, the market capitalization 1.7 billion. So Opendoor trades for a price to sales ratio of 0.12. Many folks follow price to earnings ratios. I don't believe in that. I believe in price to sales because if you're not growing sales, you're not growing anything. Yeah, you're growing financial engineering of a kind by buying back stock, etc. But if you're not growing your company on some level, you're not completely healthy, unless it's your complete intention, to not grow to not grow. But if you're not growing sales as a business, as an operating business, you're on. So 0.12 is very, very low. But there are some caveats to explaining some of this that I'm going to tell you about in a moment. Let's look at what sort of like the market forecasts are. For 2023, the forecast is that Open Door sales will have dropped by nearly half, 50%. And that's the truth. And why? Well, because interest rates went up, as I mentioned earlier, and the number of transactions went down. They pulled their horns in. You don't really want to be exposed in a market where there's declining volumes and declining prices. So of course it went down. For 2024, the current forecasts are that Open Doors sales will go up by 3%. And you might be thinking, well, Paul, why would I want to own a company that has just 3% growth? Well, you see, there's some secrets that I need to share here, right? Don't tell anybody. These are things that, genuinely, I had to work these out by being on Wall Street. So open stock secrets, which is that number one thing is that you have to understand that cyclical companies trade in a completely different way than sort of regular companies. Regular companies might be something that where you really expect consistent sales year after year. Cyclical companies, there's like a big cycle up where the transactions go up, the prices might go up, and then the transactions go down and they go down with it. Examples of cyclical companies are, for example, the semiconductor business, the chip business. The housing market in general is cyclical. Many of the commodity companies are cyclical because the commodity prices are cyclical themselves. So Open Door is going to be a cyclical company that is attached and tied to the housing market. So when you're in a cyclical company like Open Door, the numbers really are not going to look good somewhere, when things are not going well especially at or near the bottom. In terms of transactions, which is that I told you earlier that the number of transactions has just completely crashed. And that's because people are locked in. I mean, the people who have very low interest rate mortgages don't want to sell because they want to give up their mortgage. And that means there's no inventory on the market. And so the few people that are willing to buy, and for sure, if you've got 6.5% interest rates, and used to have 2%, that totally kills buyers' interest well. But there are buyers that are willing to buy. They can't find enough inventory to buy. So we're like locked in this stalemate right now, which has driven, Open's business down a lot. The other secret about cyclical companies like Open Door are that you want to buy when you see numbers go from negative to positive. Now, between 2023 and 2024, you're going to see numbers go from what? Negative 50% to plus 3%. So that's, while not seeming like a big deal, you're like, oh, well, there's just going to be 3%. Yeah, but that's a big flip. They're going from negative to positive. And from having been on Wall Street for many decades, in cyclical stocks, when you see that, that's called like being on the turn. In other words, the numbers turn. That's a buy signal. That's a buy signal that you want to be tracking. And then the other thing is that with cyclical stocks, you want to be looking at sequential sales. So I know that sounds super jargony, but most companies are compared to what they did this time last year. So every company is required to report their results 4 times a year. And if you go on CNBC or you read analysis, everyone will compare it to the same time last year. That's called year-over-year growth. But for cyclical companies, what you want to do is actually compare it to the 3 months that just happened. So for example, for Open Door, really you would be looking at, what was the numbers for the first quarter for Open Door, which ended March 31st, and you would compare it to December 31st, unlike looking at last March's numbers. So when you go and look at Open Door's numbers, you'll see that their business has improved and is beginning to improve. And improved can simply mean that things are less bad. It doesn't necessarily mean that things are like, incredible and wonderful. Less bad is still an improvement. And for cyclical stocks, less bad is also a sign for you to go and buy. All right, so let me summarize some of this together. Number one hated real estate stock is Open Door, OPEN. $2.67, $1.7 billion market cap. Why? Well, number one reason that interest rates are setting up uh, to create a huge tsunami, I believe, of buying and selling, because there's so many people that want to be moving around or want to be buying. There's massive pent-up demand to transact in real estate, but it's like so locked up by the fact that interest rates have gone up so much so fast. And Open Door has perfectly positioned itself with this 2.0 online digital platform that can really benefit from all of the buying and selling. Remember, they can earn money on both sides of the transaction, when you buy and when you sell. So this stock, oh, I forgot to mention down here, just that the other thing is that they got a ton of cash, $1.25 billion worth of cash. So there's just no, possibility of them like running out of money in the near term. They got plenty of money. And that's one of the things that, as real estate 2.0 starts to take over, legacy companies are going to find themselves in big trouble. And Open Door is going to be perfectly positioned. They've got this digital platform. They've run it now through a down cycle, and now they're ready for a big up cycle. They got a ton of cash. Everything is flowing in their favor. And importantly, the stock market is clearly indicating the fact that it's bottomed out and it's starting to move up. That's what you see in cyclical stocks. So that's it. Number one hated real estate stock. Oh, I kind of never went into, why it was really hated, but I think if you are in real estate, you can understand why. Any company that is going to come and sort of like take, commissions and change it, it's going to be hated. But that's neither here nor there. All right. If you like this video, give us a thumbs up, subscribe to the channel, come back next week. This is Paul saying bye.